Later CPA and Associates, accounting the grapevine mate.
Hi there, I'm Daniel Later, founder of Later CPA and Associates, and welcome back to our ongoing series, the 20-week tax strategy readiness roadmap. You can get your firm ready with the best tax strategies. This week, we're talking about S corporations. Specifically, when does it make sense to start using an S corporation? An S corporation is often presented as the next step for a growing business, but becoming an S corporation is not a sign that your practice has reached a certain level of success. It is a tax decision that should be based on your numbers. The main question is, after paying the owner a fair salary, is there enough profit left to justify the added cost and work? So let's talk about what an S corporation changes. An LLC and an S corporation are not necessarily two different businesses. An LLC is generally a legal structure. An S corporation is a federal tax election. An eligible LLC can remain an LLC for legal purposes while choosing to be taxed as an S corporation. With an S corp, an owner who works in the practice is usually paid in two ways: W-2 wages for the work the owner performs, and distributions based on business ownership. The business income still passes through to the owner's personal tax return. The S corporation does not make the income tax-free. So why do practice owners consider an S corporation? Well, a sole proprietor normally pays self-employment tax on the business's net profit. With an S corporation, the owner's reasonable W-2 wages are subject to payroll taxes. However, the remaining business profit is generally not subject to Social Security and Medicare payroll taxes. That difference creates the tax savings. But the goal is not to pay the owner the lowest salary possible. The goal is to divide the income correctly between pay for the owner's work and profit from owning the business. The owner still pays income tax on the business profit, even when the money stays in the business or is taken as a distribution. There is no magic profit number. People often ask, how much do I need to earn before becoming an S corporation? There's no single number that works for every practice. Instead, we look at the break-even point. An S corporation creates additional costs and responsibilities, including running payroll, making payroll tax deposits, filing payroll reports, preparing a separate S corporation tax return, keeping accurate bookkeeping records, and following special rules for owner benefits. The election starts to make sense when the expected tax savings are greater than these added costs. It also helps when profit is steady. One unusually profitable month does not mean the practice is ready for a permanent change. The IRS requires an S corporation to pay a reasonable compensation to an owner who works in the business before making other distributions to that owner. A reasonable salary is based on facts. For a mental health practice owner, we might consider the number of hours worked, number of clinical hours worked, the management and administrative tasks, supervision of other therapists, your education, license, and experience, the practice's location, and what another practice would pay for similar work. There's no automatic percentage that makes a salary reasonable. A rule such as paying 40% as salary and taking 60% as distribution does not replace a real compensation review. The salary should be connected to the work the owner actually performs. So when does an S corporation not make sense? It might not be the right choice when your profit is low or unpredictable. Most of the profit would need to be paid as a salary, or the bookkeeping is not accurate, or the business does not have enough cash to run payroll, or state taxes or other filing costs reduce the expected savings, or the owner is not prepared for the additional rules. An S corporation also does not work as a way to skip payroll. Corporate officers who perform services are generally employees, and the IRS may reclassify distributions as wages when an owner is underpaid. Let me give you a simple decision process. Before making an S corporation election, calculate your practice's real profit after expenses, estimate what a reasonable compensation for the owner is, calculate how much profit would remain after paying that salary, compare the possible payroll tax savings with the added costs, review any state tax impact, and then make sure bookkeeping and payroll systems are ready. The election to be an S corporation is made by filing Form 2553. Your timing matters, so this decision should be made through planning rather than waiting until it's tax return preparation time. Couple closing thoughts. An S corporation is not automatically better than a sole proprietorship. It starts to make sense when the practice has predictable profits, a clean financial record, a reasonable salary plan, enough remaining profits to create meaningful savings, and a system that can support payroll and tax filings. Do not start with the entity. Start with the numbers, and then choose the tax structure that supports the practice. Here's a critical thinking question for you. After paying yourself a fair salary and covering the extra costs, would an S corporation produce enough savings to be worth the additional work? Next week, we are talking about reasonable compensation for S corporation owners. So don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves, and let us help you to do just that. I'll see you next time. Bye.